Hi, welcome to the Real Estate Investors Tax Structuring and Planning seminar right now. We have Carey Lampel that is joining us on the line. She is great at actually taking real estate investors and focusing on lowering their taxes and also protecting their assets at the same time. She's been doing this for 11 years independently and has a very unique background. She is actually an attorney who received her master's in taxation after going to law school. So she's got this master's in tax degree, and she's been able to put it to work in helping not only real estate investors, but just small business owners in general, and on teaching them and educating them on how to lower their taxes. So without further ado, let me introduce you to Carey. Carey, thanks for being here.
Thank you very much. Okay, what I'm going to do today is I'm going to kind of go through a seminar that we've put together called How Real Estate Investors Can Significantly Lower Their Taxes. So I'm going to just kind of hit on different venues, different areas of tax planning that have to do with real estate investors and small business owners. I can figure out how to move the slides along. Here we go. Okay, just to let you know, of course, everybody in every situation is different, and I'm not giving legal advice right now during this. This is not create an attorney-client relationship or anything like that. This is just a general internet seminar for whomever wants to listen to it, but everyone's situation is different, so you'll want to always speak with your own tax professional, CPA, or an attorney. Again, this is not creating an attorney-client relationship between the listeners and myself, but is meant for educational purposes. My background is I have a law degree, as Ryan mentioned, and then I also have a master's from the University of San Diego in taxation, and I'm also a CTEC preparer here in the state of California. So this is a little background about myself. Just I've worked for the big accounting firms also in the past, but more importantly, in my opinion than that, is the fact that I am an investor myself. I've got, right now we own a mobile home park and some commercial medical buildings. I've had property in the GO zone and in different states, so I'm in the trenches myself, and I know the highs and lows of what people are going through because I myself am going through that as well. Okay, I'm going to start with different types of entity structures for everybody's individual situations. There's basically, when I meet with clients, they're going to come to me and they're going to say, well, I've heard about corporations and LLCs. What's the difference? All corporations start off as what's called a C corporation, and that is just basically a general corporation, and we can make what's called an S election, and that's an election that's filed with the Internal Revenue Service that allows the corporation not to pay taxes. What happens is that all profits or losses flow down to the shareholders, and they're the ones that pick it up on their individual income tax returns. There's also something called LLCs, which stands for Limited Liability Companies. Then there's, of course, partnerships, such as limited partnership and general partnerships. There's what's called a 501c3. If you ever hear that number being thrown around, that's a nonprofit. And then there is sole proprietor, which is somebody that's just doing business themselves on a Schedule C. I don't really recommend, in most cases, running a business this way because it's a couple of reasons. One, it's the most highly audited schedule on a tax return, and the second being it doesn't offer any sort of asset protection. So be aware that Schedule C may not be the way to run a business. Some situations it does, but again, as I mentioned earlier, everybody's situation is different, and if you're running just a small business and maybe not generating a lot of income, this might be the way to go. Again, depends on your own situation. Okay, I'm going to start with corporations, and there's two different types of corporations. There's an S corporation and there's a C corporation. The benefits of an S corporation are that they're flow-through, meaning that there is no, the corporation itself doesn't pay taxes. Things like medical expenses are now allowed to be deducted through the S corporation. It didn't used to be that way, but now they can. S corps don't pay federal taxes. In the state of California, I'm going to give that as an example, they pay $800, which is probably, I think, the highest in any state, a minimum franchise tax of $800, but a lot of states, they don't have to even pay anything, or maybe they'll just pay like $25, but they don't pay any federal taxes at all. They're flow-through entities. So when you file a tax return with the state or the federal government, a lot of times it's just an information return, who it lists who the shareholders are, and they're the ones that are going to pick up the profits or losses of the company. C corporations are publicly traded companies. All have to be C corps. Now that doesn't mean all C corps are publicly traded, of course, but C corporations are unlimited on who can be their shareholders. They're allowed to have an infinite amount of shareholders, which is why things that public companies are all C corporations. Anyone can buy stock in them. You don't have to be a U.S. citizen or resident. Trusts can own them. Other corporations can own them, LLCs. They allow for what's called the medical expense reimbursement plan, and they also allow for foreign partners, things like that. So a lot of times if you're looking at a situation that's, you maybe plan on going public in the future, a C Corp would be the option that you'd be looking at, whereas an S Corp might be better for a smaller mom and pop sort of business. Okay, LLCs. LLCs are great for things like holding real estate, and people will often ask me, well, should I set up an LLC in Nevada, Wyoming, Delaware, California? Where do we set the LLCs? My answer to that is I would set the LLCs up where the property is located. That way you're avoiding having to register the LLCs in multiple jurisdictions. You want to make sure to have the LLC register where your property is so that the courts there have jurisdiction over those entities, meaning that if there was a lawsuit, the courts could say, well, look, we can give this entity credence, it exists here, and maybe it will offer some asset protection. The question that always comes up is, do I need a separate LLC for each property? I don't believe so. Every time you set up an entity, again, depending on what state it's in, it can cost you between $1,200 and $2,200 a year just to run it in administrative costs. This includes filing a tax return, and the national average for a corporate return is probably around $800. Plus, some states like California are going to charge you $800 minimum franchise tax just for having an entity. You're going to probably need a bookkeeper, and you may need to run payroll depending on how your company is set up. So you're looking at probably around a couple $1,000s a year. So it doesn't really make sense to set up a bunch of LLCs if you have a bunch of properties with no equity. Used to be, people would say, in some of the seminars people go to, okay, well, I've got 10 properties, I need to set up 10 LLCs. Well, you'd be looking at $20,000 a year just in administrative costs. That is crazy. There goes all your profits. So my feeling is it doesn't matter how many buildings you own, it matters how much equity you have. If you've got 10 properties that are each 100% financed, you don't have anything. There's not really necessarily a reason to set up the LLCs as far as protecting that equity, because there is no equity. So keep that in mind. It's not really, what the amount of dresses that you have, it's how much equity that you have, and everybody's situation is different. Okay, I'm going to talk a little bit about things like depreciation. Depreciation is a big incentive that people have as to wanting to buy real estate. Depreciation is the ability to write off something, the cost of something over a period of time. And we don't get to pick out how much time we get to write that property off of, or that, be it real property or commercial property or even chattel, which is a property like a computer or a chair or something put in the purpose of business. It's all set under what's called GAAP, which are the generally accepted accounting principles. Residential property is 27.5 years and commercial is 39 years. So what this means is that if you purchase a piece of property, you're going to allocate about a percentage to the structure and a percentage to the land itself. The land itself can't be depreciated. So let's say you purchased a property for $200,000 and you decided that the structure itself was worth of that $200,000 about $170,000. You would then take that $170,000 and divide it by its useful life, which is 27.5 years. And that dollar amount is what is known as the depreciation amount. So that depreciation amount comes off of the write-offs in addition to the other expenses such as interest expenses and maybe marketing, advertising, management, water, utilities. It's an additional expense that you get to take off against the income that property is incurring every year. So that's a great thing, and that's why people love real estate. Every time you make a payment, all the principal is not deductible, but the interest is. But this is how we write off the principal. We write it off as part of the expense on the expense list on your Schedule E or on your return itself. Okay, I'm going to do a little thing right here showing the difference between married filing jointly and someone who is W-2 employee. Let's say a W-2 employee who's making $100,000 a year in W-2 earnings. They have a job, let's say, as a professor. They've got mortgage interest on their primary residence of $25,000 a year, plus they're able to make, let's say, make an IRA contribution of $5,000. They've got some rental properties showing a depreciation of $58.18 in this example here, and they've got personal exemptions of $7,300. So there's a comparison, as you can see on the slide here. If they had no real estate, everything would be the same, except for they wouldn't get the depreciation expenses. Now, we're not showing any other sort of, we're assuming in this example that the property is cash flow not negative or positive. It's just a zero, basically covering its costs. So the only write-off would be the depreciation. Again, it's collecting rent, which is being absorbed by the expenses. So you can see here in this example that the person would have taxable income, if they own these two properties, of about $56,882, whereas if they didn't have real estate, they'd have it of about $62,700. So the federal taxes are $7,500 versus about $8,571. So they'd save between federal and state about $1,400 a year, which translates to extra monthly cash flow of about $119. Okay, now here's somebody with 7 pieces of property. So this person is much more into the real estate game and planning. This person, again, is making the exact same wages. On the left-hand side of the slide, it shows them $100,000 in W-2 earnings. On the right-hand side, it shows them $100,000 in W-2 earnings. Mortgage interest is, again, the same. IRA contributions the same. But this time, because they own so many properties, they get to write off up to $25,000 of depreciation. Again, on the right-hand side, they don't get any because they don't have any rental properties. You can't depreciate your primary residence, so that wouldn't be on there. Personal exemptions are the same, and you can see how their taxable income goes down to $37,000 versus $62,000. So their annual savings in taxes is about $5,000 between federal and state, which would translate to about $416 a month just by owning those properties. Again, we're assuming these properties are making the same, they're covering their expenses. So let's say they're collecting rent of $2,000 a month, they're covering the mortgage and they're covering expenses. So again, we're assuming zero cash. We're just talking about the depreciation in this case. Okay, I'm going to talk a little bit about holding versus flipping. Holding property, in my opinion, it's best to hold it either in an LLC or a limited partnership. Holding property would consist of property that's owned for a day more than a year, so anything that would be considered a long-term would be, again, 366 days or more. Flipping property, a lot of times it's maybe good to do that or consider doing it inside of a corporation, and these are holds that are under 1 year. So again, if you were holding property or you're selling properties, buying them, fixing them up, and selling them, in that case, it might be worth considering setting them up inside of a corporation and selling them that way. Okay, I'm going to talk a minute about the real estate professional status here. The Internal Revenue Code says that you need to spend at least 750 hours a year and more. It should say and, the slide says or, but it's actually and one more hour than in your current job. So if you have a current job and you're working 1,000 hours in that job, you'd have to do an hour more, so 1,001 hours actively engaging in real estate. Only one spouse can meet the requirements, so you can't combine. If you're married, one person can't do, say, 300 and the other one does 350 hours or something, or 450 hours plus one. It doesn't work that way. It has to be one person doing the entire 750 hours minimum. So unfortunately, you cannot combine the two, and that's how you would be able to prove it. If you have a full-time job, it's pretty difficult test to make because, again, you have to do an hour more than in your full-time job. If somebody else manages it for you, that time can count, but it's a difficult test, and the more you're involved, the better your chances of making the position and the argument that you're the one that's managing it. So if you've got multiple properties all over the country with multiple managers, again, that time doesn't necessarily not count. It's just a preponderance of the evidence test, and you're going to have to show that you have spent, a lot of time directly dealing with those management companies and with the tenants themselves. So again, it's super important in these cases to keep good logs, keep good records, write down every time you deal with your properties, because you're making the assertion and the position that you are spending an hour more than you are in your regular W-2 job. Okay, another reason for forming an entity would be asset protection, such as lawsuit protection. There's sometimes people hold properties in their names, and there are examples, I'm sure everyone's heard, where somebody, let's say, was sued, they would be able to get the properties that were owned by the landlord. So if you had a bunch of properties with equity in your name and someone is hurt in one of the properties and they want a judgment against you, they could conceivably go after everything you own, which is another reason why people like to set up entities to protect their assets. This can become a pretty this could be its own slide or its own a whole class on just asset protection and mitigating damages and how much equity you would need to have. But just want to put the idea out there that, again, a lot of times for asset protection purposes, people like to set up things like LLCs or partnerships. Having living trusts does not do anything as far as asset protection. They're great for avoiding probate, but they do not offer any sort of asset protection other than just taking your name off title. So the idea of having a land trust, not saying that they're not, it's not a good idea, but its purpose should not be asset protection, because if you can get to anything in a living trust, your creditors can get to it as well. It is revocable, and it therefore is not going to offer any sort of asset protection other than keeping your name off title. Makes it a little bit harder to find. Okay, insurance, umbrella policy. This is a question that comes up a lot too, and I say, you know what, why not have it? It's kind of controversial. People go back and forth. Should they have an umbrella policy or an LLC? If you can afford it, have both. And make you sleep better at night. There's no question about that. I myself have that, and I recommend it. Certainly you want to avoid the lawsuit in the first place, but if you can't avoid it, at least having an insurance policy should add some protection to you. So they're usually not too expensive if you bundle them with your other insurances. So you want to ask whomever it is your insurance carrier is, how much it would cost, and make sure they would cover additional properties that you have. I am of the school of thought, why not be extra cautious? So again, and they need to be made aware too that the properties, if you're transferring title into a limited partnership or an LLC, the insurance is still valid, that doesn't negate any contracts you have with the insurance company. So make sure to ask that question. But again, I think it's probably a good idea to have insurance, and it's not a very expensive thing to have, and it certainly can be worth it if something were to happen. Okay, I'm going to talk a little bit about pension plans. There's basically two types of pension plans. There's what's called qualified plans and non-qualified plans. Qualified plans are plans that are governed under the law of ERISA, which is an acronym for the Employee Retirement Income Securities Act. Pension plans these plans are great from the standpoint that if anyone ever sues you or got a judgment against you, they can't touch any of the monies in these plans. These are your standard 401k plans, IRAs, SEPs. All these plans are all qualified plans, defined benefit plans. The only problem, for lack of a better word, of these plans is that because they're governed under ERISA, the Department of Labor has laws that says, look, you cannot set up these plans and make it so that the owners of the company or only the highly compensated people are able to contribute to these plans, and the rank and file employees are not. So they're very limited as far as what you can contribute if you have employees. So if you're in a situation where you're incorporated and you're the only employee, then these can be great. And there's things like defined benefit plans where you can be putting in, I've seen clients put in, $150,000 contributions into these plans, which are great because that's again a deduction to the company itself. So that can be great, but again, if you've got a situation where you have employees, then these may not be an option for you. There's also things called unqualified plans, which are a bit more controversial in that a lot of times what happens is there can be situations with abuse with these plans or people trying to overfund these plans. So they're not governed under ERISA, meaning that you don't have to take into consideration the employees in these plans. You're able to put in more money. However, they are limited on what they can invest in, and oftentimes they're limited to insurance contracts and things like that people, especially people in real estate, are not interested in. So sometimes you have to kind of choose which path you want to go. There is not a situation where you can put in as much as you want, even if you have employees, and invest it however you want. That would be ideal, but it doesn't exist, unfortunately. So you have to kind of pick which things are most important to you and kind of do your planning around that. but I just wanted to kind of put these out here. You can, with qualified plans, you can invest in real estate if provided they're set up correctly. Certainly you can invest in self-directed plans. You can invest in real estate. As far as choosing what you will earn, this is an example here of somebody who maybe is incorporated and they're able to give themselves a salary. There's definitely the benefit of doing that. Taking a salary, as long as it's a reasonable salary for the industry, and by doing that, by picking out if it is reasonable, what I would do is I would go on to websites like monster.com or maybe Craigslist and see what is standard in your industry. Do some research, keep records of it so that if it's ever questioned, you can show the IRS, well, this is how much somebody who is a programmer, let's say, makes or something. So that way you're able to show them why you're taking that kind of salary out. And then other profits from the business can come out. Those profits are called dividends, and you can take the dividends. And dividends are taxed lower than salary, which is why it's nice to be able to take dividends as well. But everybody always asks me, then why take a salary? Well, there's a couple of reasons. One, you have to. You cannot just take dividends. It doesn't look good. The IRS doesn't like that. They want you to take some salary, again, a reasonable salary. The other reason is if you want to make a pension contribution, you need to have earned income, and dividends are not considered earned income. Dividends are profits. This is why if you own stock, let's say in a public company, and you receive dividends, but you don't work for that company, those dividends, although maybe qualified dividends, you're going to pay taxes on them, but you won't pay dollar for dollar as much tax on those dividends as you will from a salary that you earn. So people look at me when like, that doesn't make any sense. You mean you pay more taxes on money that you earn than the money that you just get as being an investor? And the answer to that is yes. That's the reality of the situation, and that's the law. So again, it's not necessarily the fairest thing, but the reality is that you pay more money you pay FICA and Medicare on earned income, whereas dividend income you do not. So that's the main difference there. Keep in mind another reason that besides wanting to make sure that you pay something into FICA, Medicare, and having the ability to fund a pension, you also want to show that if your salary is too low, what happens is you'll have a hard time getting a loan. And people, this is a double-edged sword. Everybody wants to show that they're not making very much money, but you want to try to get finance or anything, you're going to need to show some salary. So you need to keep that in mind also when doing your tax planning. You can't go to a bank and say, oh, look, I only made $15,000 this year and expect them to turn around and give you a loan for $500,000. Those days are no longer. Maybe 5, 6, 7 years ago you could do that, but you can't anymore. So because we don't have stated income loans, you do need to prove your income, and that's another reason to take a reasonable salary. That, and also it's required by law. Okay. So here's a little example on this chart here. I'm going to kind of show you how the money kind of can work. So let's say you have a corporation or an entity. What happens is that you get incorporated and you're not a Schedule C anymore. The company itself is what earns the money. So you yourself aren't a 1099 anymore. You're actually going to become a W-2 employee of your own company. So your company will earn the money. It will write off all its ordinary and necessary business expenses, and anything that's left is called a net profit. And that net profit is basically going to be a profit to you that you're making, and that will come down to you again on what's called a K-1. And a K-1 is a bridge basically between you and your company. You'll take a reasonable salary from your corporation, just like you would any other corporation that you're a shareholder of or not a shareholder of. That salary will be offset by your Schedule A deductions, such as your mortgage on your house, charitable deductions, real estate taxes paid to your state, those kind of things. And then whatever is left, you can maybe put into a pension plan. So that's going to be another tax deduction to the corporation. And again, the corporation doesn't pay taxes. So you can see how this is an example how somebody can really mitigate tax damages by just doing some good planning. So here's an example. We call him John No Dough, and he's a real estate investor without who is not incorporated, who's just doing everything in his name but doesn't have an entity. We're going to say, let's say this guy is a computer programmer, and he's making $150,000 a year, and that's going to go on a Schedule C. He also has some interest income from some stocks of $10,000. He's got business expenses such as interest, repairs of, say, $30,000, which is going to go on his Schedule C and offset that $150,000 of income. Student loan interest deductions, which are limited to $2,500. I wish $2,500. So his adjusted gross income is about $127,000. He has a property that he owns, and his Schedule A deduction is $20,000. So his total taxable income at the end of the day is roughly $107,000. So his total federal and state taxes are approximately $29,000 to $30,000. So I've got him here as $29,749. So that's his approximate tax that he owes between federal and state. This is an example of him maybe being incorporated. His company grosses $150,000 a year. It's got business expenses of, say, $50,000, things like business development, interest on loans for things that it rents, gasoline for its car, business, meals, and entertainment, which are 50% deductible, repairs, things like that. And then he's paying himself a salary of $50,000 a year, which is a reasonable salary for his industry. Then he's also going to make a contribution to his pension based on his age of, say, 40 years old and his salary of $50,000. So now he's going to pick up $25,000 a year as a profit. So because we've got $150,000 minus his business expenses, minus his salary, minus the $25,000 of his pension. So all that's left is $25,000 in dividends. So his personal tax return, he's picking up his salary of $50,000 plus his dividends of $25,000 minus his student loan interest deduction there, which is again an above the line deduction, minus his itemized deductions, those aren't changing, and his real estate write-offs of $11,000. So now his taxable income is $41,500. And this is an example where he would only owe between federal and state about $9,200. So again, by him owning real estate and having his own business, look at how much he's able to, the difference he's able to, you can see the comparison of somebody who's got an entity and someone who doesn't, and somebody who, and having real estate. He's going to save about $20,000, close to $25,000, almost $20,500, which is really a great return on his investment if he looks at it that way. Again, to have this company in the first place, though, he's going to have to pay the state of California, assuming that's where he lives. We're going to use that as an example. He's not going to pay federal taxes, but he's going to pay the state of California $800 minimum franchise tax. He's going to need to pay an accountant about $800 a year to do his return. Bookkeeping will probably be around, depending where you are in the country, maybe around $600 a year, give or take. So probably around $2,200 a year. Give or take, a couple $100, of course. Okay, just want to touch real quickly on the Taxpayer Relief Act of 2007, and if people are out there worrying about losing their homes, they're not going to have to pay income taxes on cancellation of debt on their primary residence up to a couple $1,000,000, which is huge relief for people, of course, because it's stressful enough to have to lose your home, let alone having to pick up the cancellation of debt on that property. That goes through 2012 and hopefully will be extended. So it's hard to say, but my guess it would be just because this is an election year and nobody wants to be the person that says, oh, by the way, you guys, you're going to have to pick up your lost house as cancellation of debt income. It's not a very popular position, and this is an election year. So again, as of right now, it's not extended, but my hope is that it will be soon. Rental properties is not the same. Rental properties, you do have to pick up the cancellation of debt income. However, if you are going to lose those properties, which you would be if you were getting cancellation of debt income, oftentimes you'll have a loss, and that loss will offset that income. So that's something that people need to be aware of, because a lot of people are very scared from walking away from properties. They don't want to have to pick that cancellation of debt up as income. The other thing to be aware of is that if you are insolvent, and that doesn't mean bankrupt, but it means insolvent, meaning you have more liabilities than you do assets, then you will not have to pay taxes on that cancellation of debt income either. So there's a box that's actually checked. There's a schedule that we file with the tax return that shows that this is the case, and then if it's ever audited or questioned, you'll have to prove that you are in fact insolvent. But this is a really good safe harbor for people that are concerned about having to pick up cancellation of debt income, meaning that's the 1099 CODs that you get from the bank if you short sale or foreclose on a property. Okay. Federal, again, primary residence, no tax up to $2 million. Rental property, it is taxable. If properly structured, and everybody's situation, of course, is different, it may not be a problem. So everybody's, again, is a different situation. California follows up to $500,000 with regards to cancellation of debt income on the primary residence. They did adopt that law. Okay, again, this is basically reiterating what I just said about being bankrupt or insolvent. You won't have COD income on your primary residence. If you're not bankrupt or insolvent, you will be taxed. However, there was a bill that was passed. This slide was made actually a year ago, or 2 years ago now, and saying that California residents won't have to pick it up on their primary residence. So that's good to know as well. Okay, changes to the tax code. We did a slide, Kerman Kane was still running, that shows how things change so much, but not anymore. So things are always changing. People ask me, what's going to happen, what's going to happen? And the reality is we never know. Every time a case comes down in tax court, the law changes. So don't worry too much about rumors that you hear until they're law. They're just that, rumors. And only about 3% of all bills that are ever put into front of Congress ever become laws. With taxes, it's more an issue of things that come in front of the tax court. So just make sure that whomever you're working with is keeping abreast of the laws. Again, there's so many rumors down there, flat taxes and value-added taxes and sales tax, national sales tax, things like that. Until we actually have it become law, it's just that, a rumor. So again, don't worry too much about it. We hear now, no more interest write-offs, but I don't think any of these big things like that will happen, especially in a year when we are going to be having elections. We would love to share our thoughts with you if you're interested in having, we do have a newsletter we try to send out about once a month as far as new laws. So you can go to taxstrategyprep.com to sign up for our free newsletter. We just email to you. You can just delete it if you don't want to get it. We also try to keep everyone informed, and that is a free newsletter. Okay, so here we are. This is our office. We are in San Marcos, California, and if you would like to set up a consultation with us, either phone conference or personal conference if you're here in Southern California, or anywhere for that matter, please feel free to contact us at any time. And that's me. That's our phone number. And again, you can always make a phone conference or come on in and see us, and we will be happy to review your tax returns. It's free, and look forward to meeting with you. Thank you so much. 760-692-0242, 760-692-0242. Look forward to hearing from you soon.
Thanks so much, Carey. That was a great job, and I'm sure there's a lot of information that was covered there. There's probably a lot of people that want to go ahead and take advantage of the free consultation, because everybody's situation is so different, and there's just so many little caveats to the tax law. The IRS tax code is over 44,000 pages long, so it's great to have someone like Carey that can actually run through that, especially for the real estate investors. About a third of our clients are actually real estate investors, and we're known for dealing with folks who deal in real estate every day. So we'd be happy to take your call, and we hope you enjoyed the educational component of this. Feel free to give us a call if you'd like. Thanks so much.